Okay, forgive me, but I'm also going to just snap through this rule number 7 because we've got so many rules to cover and very little room on the CD-ROM. And this is to learn portfolio tricks. I'm often asked, how many stocks should a long-term investor have in their portfolio? Now remember here I'm talking about long-term investors. I'm not talking about spread betting and CFDs for this rule. It's the long-term stuff. Well, I'll tell you the quick answer. 15. And the reason you should have 15? Very simple. The level of risk for each new stock you add drops in your portfolio as you'd expect. That's diversification. Look at the risk levels here. Yeah? As you add more stocks, the level of risk drops as you add stocks. You see we're adding stocks on that axis. Around 15, what tends to happen is by adding more stocks, the level of risk reduction is fairly minimal. Now you could say, well, maybe it should be 20, others might say it should be 14. I think it's 14 to 15 is pretty much the optimal level of number of stocks you should have in a portfolio. That's one of several tricks professional and wealthy investors know. They know not to have 100, they also know not to have 8. They also know to make sure that those stocks between themselves are not highly correlated. Those things then accentuate or leverage up the kinds of returns you can have, all other things being equal, in an investment portfolio. But I just wanted to mention that particular trick. There are others. For instance, we should know, how do you find which one stock you could replace in your portfolio which will still keep the same likely level of reward that you have but reduce risk? Equally, how do you find out what happens to your portfolio if the market drops 10%? And how do you reduce that impact on your portfolio? What's the correct number of stocks for the long term? Well, we've got the answer to that one. But equally, if you said to me, you know what, Alpesh, I'm 33, at 45 I want to have a certain amount of wealth, and I'm going to save this amount of money, this is how much money I've got to start off with, I'm going to save and add this amount of money each year. Tell me what kind of returns I need to be targeting with the level of risk I'm willing to take so that I hit that kind of target. And we can do that through software for free, which can do it very quickly. And I can say to you, you need to be targeting 12% returns with the level of risk that you've mentioned. And in order to get those kind of returns, you need to have this kind of portfolio composition to get to the profit level, the wealth level that you want. Guess what? All of this can now be done without an IFA. It can be done through computer systems for relatively little amounts of money, or free in very many cases. That's a portfolio trick. That's what the wealthy know how to do. They also know lots of other ways of improving their performance from being average to being more optimal, such as there. So at the click of a button they can see how to improve their portfolio performance. Equally, if their portfolio is over here in terms of return and risk over there, and it's composed of these stocks that you can see here, then through the click of a button and through a bit of analysis we can work out how to get return even greater but without increasing risk too much, by maybe changing, for instance, a stock like this, which might be seen as a drag, and buying more of a stock which is, say, around this level up here. If you know how to do those things, then guess what? You're more in track of being a professional investor and just being that much better. It's for that reason we created a whole host of CDs which deal solely with longer term investing. So, rule number 7, learn the tricks, the portfolio tricks of wealthy investors. I've given a couple there. There's a whole lot more to learn.